We are in the middle of one of the most exciting journeys per se in terms of where the stock market is positioned right now. Uh, with the BSC Sensex at close to 34,000 and with a PE ratio of about close to 24, we are probably going to enact the crash of 2001 again. But this time, my sense is that the crash might not be as steep as what we saw in 2001, or even as steep as what we saw in the later half of 2008. Uh, Given the macroeconomic factors, there are not many fundamentals involved in terms of driving the markets up. We are seeing a lot of negative news flowing in. Uh, the financial crash right now, starting with most of the PSU banks, is probably the start of this cycle, and very soon we would see that this this negative pessimism will flow into the consumer durables and consumer led sectors as well. The auto sector, if you see, has been pretty much resilient through this fall of close to about 1,500 points on the Sensex. But my sense is that when the fall happens, it's going to take every sector, and it's the question is just going to be which sector falls the most and which sector falls the least. So we should at least be prepared at this point to see a fall of closer to 10% from the current levels. And if we do that in the next 6 months, I don't think we are in the safe zone of buying again. We would probably be comfortable buying when the Sensex is around trading at a P ratio of 16 to 18 than the current P ratio of 24 plus. Uh, with a PB value of close to 4, it's pretty expensive, and with fundamentals not driving in, I don't see a reason as to why we should um, see a huge rise in Sensex for the next couple of months at least. So my recommendation to most of the investors, especially retail investors, would be trade with caution. We're already seeing FIIs pulling out money, so try and keep some cash handy because you can never predict the crash. But if you have cash handy at any point of time, you can probably average your investments. Don't be in a hurry to averages yet because we're going to see uh, the fall is not going to be like a pin. The fall is going to take some time, and we should probably be hoping for a good amount of consolidation by the end of this year. So hopefully, this will present a great buying opportunity not just for FIIs, but keep a watchful eye. You would probably get a lot of promising stocks at very cheap valuations by the end of the year. For traders, it's always a game for identifying the peak and identifying the trough. So we should see a lot of trading opportunities during this fall, but be careful to trade with a stop loss because this is not going to be a market which is going to give you the returns of 2017. We should be expecting a lot of consolidation and therefore wait for the right buying opportunity. There are not many stocks today which are available at great PE multiples. A lot of experts are today saying that there is a dearth of finding the right investment in today's market. So it's important for us to know this and trade with caution. Wait for the right fall. hold your long-term investments if you have already purchased them and sitting at a loss. Um, Unless and until you have put in a bet on fundamentally poor companies, there is not much reason to worry. The India growth story is still intact, so that's important to understand. But without the global macroeconomic factors aiding, I don't see a reason as to why India would continue to command a premium over most of the global markets. Today, as we stand, India is probably one of the most expensive markets in the world. So, therefore, my own sense is that we should wait for the right opportunity to invest. We would probably get the levels which we saw in 2004, 2005, somewhere around the PE multiple of 16 to 18 by the end of this year, or maybe in the first quarter of next year. All the best. Thank you.